Hi, Jim Gore from THOR Wealth Management. Well, people are really feeling bad out there, and it's just not me saying that. If you look at this chart, this is looking at the Consumer Sentiment Index. This is the University of Michigan survey. And you can see that sentiment for the consumers is the lowest it's ever been since the index was created back in the 1950s. We're lower than we were when inflation was raging in the late 70s and we had interest rates over 20% in the early 80s. We feel worse than we did in the Gulf War. We feel worse than we did at the bottom of the market in 2009 after the market corrected over 55%. So, and you can see that not only are we at the lowest point, but the drop off has been more significant, the steepest drop off we've ever seen in this index. So the question is, are things as bad as we feel? And the answer is no, not yet. And there's some things that we're watching out for, and I'll get into that later in the video. First thing is you have to look at consumer debt levels. So let's look at the consumer debt levels. This is going back to early 2000. And you can see from 2000 and 2008, debt levels were going up. We had the crash of the stock market, and consumers started paying off debt and not increasing their debt levels. We saw that not only in the economy, but we also saw that with our clients. But what we've seen, though, over the last several years is that the debt levels have started to go up. More importantly, in the last year and a half, we've seen that those debt levels actually go up at an accelerating pace. This gives us some concerns right now because we keep on adding debt levels onto our balance sheets as consumers. That could be a problem. So we're watching those debt levels, and there's two things that we're watching out for on those debt levels. First off is auto loans. Are people defaulting on their auto loans? If you look at this chart, it can be pretty scary. If you look over the last year, defaults on auto loans are up 94%. So this looks scary, but you have to put it in context. And this is why you have to be careful with the charts that you select. Because this is a yearly chart, this looks pretty scary. But let's step back a minute and go back to defaults over a long time period. And you can see here that default levels have gone up recently in the last year, but they came markedly down back in 2020. Why did they come down? Well, people were flush with cash because they were getting refunds from the federal government. So guess what? They were able to pay off their auto loans. Now we're watching this closely because people don't have that cash anymore coming in from the government. We're starting to see defaults go up. And this is something we're watching very closely. That's the bad side of what we're seeing is these defaults go up, but it's not going up at a rate that concerns us at this point. One thing that is good news is the consumer and their delinquency on credit cards. You've actually seen this drop over the last year and a half. It's down about 9%. So these are credit cards that are 90 days delinquent. And you can see we're nowhere near where we were back in 2009, 2010, when people were very delinquent with their credit cards. It's actually come down here. And that's a good sign because people have cash to pay off their credit cards, or at least pay the minimums to their credit cards. So, what we're talking about here, so if you look at the auto loans and the loans here for the credit cards, things are not as bad as we feel. However, the question is, we're feeling bad, but are we there yet? The answer is no. And the reason for that is if you look at the credit card delinquency rates to the unemployment rate, and you can see it almost goes in tandem here that when credit card delinquencies go up, it's because of unemployment. Right now, the unemployment rate is the lowest that we've had in a very, very long time. But the Federal Reserve is saying they want to raise interest rates to actually increase the unemployment rate. So what's going to give us some concerns and what we're watching out for is to start seeing that unemployment rate starting to go back up. And then at that point, because people are unemployed, what happens? They can't pay off their car loans. They can't pay off their credit cards. You see those delinquency rates go up. And that's usually when things are pretty bad in the economy. So maybe the sentiment index is a little bit ahead of itself. And this is why we're saying we're not there yet, but we have to watch out with the Federal Reserve. If they raise interest rates too far, too high, too fast, it could have an impact on consumers. And maybe that's what we're all afraid of. If you have any questions or concerns, as always, reach out to us here at THOR or reach us on our website, thorwealthmanagement.com. I look forward to talking to you in a couple weeks. Take care.